Well, it is my pleasure to welcome back one of my favorites. I've had Richard Duncan on the show twice now, as far as I remember, and this is the third time. Let me tell you a little bit about Richard. Richard is the author of four or five, but at least four books that I know of on the global economic crisis. Well, that's actually one of his books, but he's got four books on the global economic crisis, including the international bestselling book, The Dollar Crisis, which forecasted the global economic crisis of 2008 with extraordinary accuracy. His latest book, which is what we talked about 2 years ago on the show, is The Money Revolution, How to Finance the Next American Century. Very interesting book. I highly recommend it. So Richard has served as the global head of investment strategy at ABN AMRO Asset Management in London. He's worked as a financial sector specialist for the World Bank in Washington, D.C., and he's headed the equity research department for Salomon Brothers in Bangkok. He's also worked as a consultant for the IMF in Thailand during the Asia crisis. Now he publishes a fantastic newsletter, a video newsletter that I'm a subscriber to called Macro Watch. And it can be found at his website at richardduncaneconomics.com. So plenty of information there. I suggest you go and check it out. I think you'll like it. Richard, welcome back to the show.
Marco, hello. Thank you for having me back. It's been a while.
It's great to have you back. I actually miss talking to you, even though I hear your voice all the time on Macro Watch. But, you've got all kinds of great content. And, sometimes people wonder, well, why should I, be interested or follow macroeconomic factors or news or events or even trends? And, I always say, look, you can be focused on all the micro stuff, how your property is performing or how the stock market is performing or anything like that. But everything happens within the context of a bigger picture. It's on a global stage, as I like to call it. So if you have an idea or an understanding what's going on globally, economically, in the big picture, you can maybe see down the road to see where things are headed and make smarter decisions about your investments, your finances, and all that stuff. Do you believe that true? Is that true? Is that your philosophy as well?
Absolutely. Macro developments definitely drive the economy at the micro level. So if you understand the big macro picture and the trends at the macro level, you're going to be in a much better position to make wiser investment decisions. And on top of that, it's extremely interesting also just to understand what's going on at the macro level.
Yeah, very, very much, very, very true. What I did for today is, as you already know, but just for our listeners to know, I kind of broke today's episode down into essentially six topics or six categories that we can maybe hit on for about 5 minutes plus or minus each, depending on how long you want to go, because we can go down a rabbit hole on all this stuff. But I think all of these things are not only very interesting, but they kind of play into what's going on in the U.S. economy and how it might impact us today and down the road next year and the years to come. Before we do that, I just want to touch on something else that I know you've mentioned several times, and I think you have. I get the sense you have a passion for because you brought it up even years ago. But that is, the establishment of a U.S. sovereign wealth fund and how that could potentially benefit all Americans, maybe people all around the world, but help Americans, increase their wealth, aid in U.S. national security, whatever it may be. But a lot of people don't understand what it is. It's still a relatively new topic. Maybe you can talk about what it is, how it would impact the U.S. and Americans, and where we are with it and where we're going with it, because I know it's now becoming more and more of a topic of conversation.
Right, absolutely. In fact, earlier this month, September 5th and 6th, first former President Trump on one day, and then on the following day, the Biden administration both came out stating that they now support the establishment of a U.S. sovereign wealth fund. And for me, this was just fantastic news because, well, for one thing, my last book, which was discussed in June 2022, it was called The Money Revolution, How to Finance the Next American Century. And the entire objective of this 500-page book was to persuade the American public and U.S. policymakers that the United States could, should, and in fact must invest in new industries and new technologies on a multi-trillion-dollar scale over the next decade. And it laid out how this could be done, explained why it was affordable, why it was necessary, and in a sense, this is exactly now what both political parties have come out in favor of. So I was jumping up and down at this news. This was just unbelievably good news, not only for my book, but I believe for the American public, for U.S. national security, for our future prosperity of our country. When we spoke last time, it was June of 2022, and I was very downhearted at that time. My book had just come out a few months before, in February, and in this book, I had argued that the U.S. government could finance a very large-scale investment in new industries and technologies over a decade without causing high rates of inflation. Well, of course, because of COVID, supply chain bottlenecks, followed by Russia's invasion of Ukraine, just a couple of months before we spoke, we got a very big spike in inflation, with inflation peaking at slightly above 9% at the CPI level, just around the time we spoke. And so that was very bad news for my book. My book had bad timing, but of course, everything was looking quite dire for the economy as well. The stock market had tumbled something like 25% from its peak. Inflation was high. So, Marco, things are looking so much better now than the last time we spoke. That was June 2022. My book had just come out, and we were really, much of what we discussed at that time was my book. It was called The Money Revolution: How to Finance the Next American Century. And the whole theme, the entire objective of this 500-page book was to persuade the American public and U.S. policymakers that the United States could and should and really must undertake a very large-scale, government-financed investment in the industries of the future. Things like artificial intelligence, developing things like fusion, investing in quantum computing, biotech, nanotech, genetic engineering, and all of the industries of the future. And I argued in this book that the government could easily afford to do this. And I explained how it could be financed at really no cost to the American public. And I also argued that all of this could be done without causing high rates of inflation. Lo and behold, my book had come out in February of 2022. Inflation started spiking to the highest level that we had seen since the 1970s as a result of first the COVID pandemic and global supply chain bottlenecks. And then just a few months before we spoke back then, Russia had invaded Ukraine, and that drove up oil prices and food prices and metal prices again. So we got this huge spike in inflation. And that was really bad news for my book. And so I was quite downhearted at that point. And not just because of my book, of course, but the outlook for the economy was very bad. The stock market had plunged something like 25% from its earlier peak. The Fed was hiking interest rates aggressively. Inflation was moving up rapidly. Everyone was expecting a recession, and things were looking really quite dire in the middle of 2022. But luckily now, things have greatly improved. The inflation rate has moved back down to 2.5% most recently. The Fed's now starting to cut interest rates, and it's a very different environment. The stock market has soared. The low, I believe, was around October of 2022, and now it's been going up and up and up. And then 3 weeks ago, so let me tell you how this evolved for me. Things were not looking good at all when we spoke, but a few months later, in August, Congress passed the CHIPS and Science Act, which allocated $280 billion of government funding for investment in new industries and technologies, with $52 trillion being directed at developing semiconductor factories within the United States, and the rest being allocated to other high-tech industries that I recommended in my book. So that was a very big step forward in the right direction, and I was pleased to see that. But $280 billion was just not large enough for many reasons, but perhaps most convincingly to your listeners, because China is investing so much more than that. And China is overtaking us now technologically, and therefore soon economically, and consequently soon militarily. And so we're really facing a grave national security threat, and we need to invest on a much more aggressive scale. And $280 billion, which was due to be spread out over 5 years, is just simply not enough. We need much more than that. But that was a big step in the right direction in August of 2022. Then a few months later, I was invited by a congressman to come to Washington and make a speech at a policy dinner to about 15 members of the House Ways and Means Committee, explaining the ideas in my book, and trying to persuade them that this is what the U.S. really needs to do, and we could easily afford to do so. And so that I was thrilled to have that opportunity. That was a real honor for me to have that chance to share my ideas with congressmen and congresswomen. And then 3 weeks ago, the greatest thing happened. Just back to back, 2 days in a row, first former President Trump, and then the following day, the Biden administration, both came out saying they now support the establishment of a U.S. sovereign wealth fund, which is exactly what my book was calling for. So I was jumping up and down at that news. I mean, this is exactly what I'd been calling for in the book. When we first spoke, most recently about the book, it didn't look like it had very good prospects at all. And now it seems to be a bipartisan agreement that this is the direction our country needs to go in. And that's exactly right. This is the direction our country needs to go in. Now, so what is a sovereign wealth fund? Other countries have sovereign wealth funds. Many countries do. The largest is Norway's. It has $1.7 trillion in its sovereign wealth fund. But Singapore has very successful sovereign wealth funds. You can think of China's economy as just one giant sovereign wealth fund, since the government owns and controls everything, and it's all directed at them becoming the most powerful country in the world. But some people have asked, well, why does the U.S. government need to have a sovereign wealth fund when the government already makes investments in various technologies and developing technologies? Of course, the government invests in things like DARPA. DARPA's focused on developing future technologies. The government makes a lot of investments in military technology, and it invests in a lot of things. So what's the need for a sovereign wealth fund? Well, the difference between what the government is doing now and a sovereign wealth fund is with a sovereign wealth fund, the government would actually make investments in existing companies and in startup companies in these industries of the future, but they would actually keep an equity stake in these companies, so that when these companies create extraordinary technological breakthroughs, which they would do if funded on a large enough scale, then the government, being an equity shareholder, would keep its share of the profits. In other words, the American public would actually be the owners of these companies. Whereas now, what the government does, it makes investments, and then the private sector more or less just adopts the investments, that adopts the outcome of the investments. For instance, almost everything in your smartphone that makes it smart is the result of government funding in basic research. Semiconductors came from government funding. GPS, touchscreen technology, and of course the internet itself. All of those things came from basic U.S. government investment in basic research and development. But the government didn't actually directly profit from that.
Right.
With a sovereign wealth fund, when the government invests in biotech companies, for instance, and one of them invents a cure for cancer, then this thing is worth $1 trillion on NASDAQ. And the government is an owner of this company. In other words, the American public is an owner of this company. When the government-backed company develops fusion, and we have cheap, limitless fusion, then that's such a complete game changer. That would be extraordinarily valuable. And the American public would be the owner of these companies. And so the American public would actually expect to receive dividends or free electricity, free cancer vaccines. And the income, these sorts of investments would be so extraordinarily profitable that they would pay for themselves many times over in a relatively short space of time. And when they did, then we could bring down tax rates or even begin to pay down the national debt. So rather than these large-scale investments in new industries and technologies driving up the national debt, I actually think that they would be so phenomenally successful that they would result in being able to reduce the government debt. They would pay for themselves many times over. So that's sort of been the big news in my world recently, is that now both political parties are calling for the establishment of a U.S. sovereign wealth fund. So I think it's really very important for the public in general to understand what this is and to understand why it is such a great idea, and to understand that they will benefit enormously as a result of these investments that the government will make in a sovereign wealth fund.
What you're describing could potentially have massive, like almost unbelievable economic impact on the country, especially in terms of the ever growing and what seems to be spiraling out of control national debt and the cost of servicing that debt. But yeah, I mean, if what you just described makes a whole heck of a lot of sense in terms of having a wealth fund that's U.S. based, that's an equity owner in emerging and cutting edge, bleeding edge technologies that could be massively, massively profitable. It would be great for the U.S., the public, the humanity at large. I mean, it would benefit all countries. So yeah, it sounds like a huge deal.
Yeah. So in the book, I stressed how easy it would be for the U.S. government to fund this sort of investment on a very large scale. I used the example of $10 trillion over the next decade. Now, that sounds like a very large amount of money, and of course it is. But during COVID, when COVID started, U.S. government debt increased by $2.8 trillion in the second quarter of 2020. So a $2.9 trillion jump in 90 days. And the Federal Reserve created a similar amount of money at that time, $2.9 trillion, and essentially bought up the government bonds and financed it all. So what I'm proposing is, not a multi-trillion-dollar investment over 90 days, but over a decade. And that could easily be absorbed. And investments on a trillion-dollar scale over a decade would it would turbocharge U.S. economic growth. It would induce a new technological revolution. It truly has the potential to result in extraordinary medical breakthroughs. We could probably cure all the diseases and extend life expectancy by potentially decades. And on top of all that, shore up U.S. national security, because right now our national security is in danger because we're being overtaken by China. China's government is investing very aggressively in all the technologies of the future. And that's why they got 5G years before we did. That's why they have hypersonic missiles and we don't. That's why they're dominating the electric car industry and the electric battery industry. They are overtaking us. And this is a real threat to the United States' future. And there's no reason we have to allow China to surpass us. The United States does not have to be a declining superpower. If we invest on an aggressive enough scale, we can the first American century doesn't have to be the last. These sorts of investments will finance the next American century, as the subtitle of my book suggests.
Right.
So all this, the funding is available. All that is lacking is the imagination and the willpower to drive these investments forward. And if we do, the economy is going to grow very much more rapidly. Everyone's going to become wealthier and healthier, and we'll have U.S. national security guaranteed for generations to come. So this is an extraordinarily good idea whose time has come, and it now has bipartisan support, and the American public should get behind it because they're going to be the major beneficiaries of this.
Yeah. So bottom line is the wealth fund is not for issuing grants to companies. It's really an investment fund where it's taking equity ownership in these new and developing businesses in the U.S. Right? It's essentially an equity fund.
That's right. Rather than making grants and seeing the government money just fly out the door, it would be like the government's acting like a venture capital company where it
Yeah,
backs the startups and
yeah.
with
Seed
lavish
capital.
funding on a scale that's so large that it just simply can't fail. For instance, right now, the funding for the National Cancer Institute is only about $6 billion a year. Uh, 600,000 Americans die of cancer every year.
Yeah,
$6 billion is not curing cancer. Back a couple of years ago, when the Fed was doing quantitative easing on a very large scale, the Fed was creating $120 billion every month. So $6 billion is just 5% of 1
yeah,
month of quantitative easing.
yeah,
How about take half a month of QE and increase the National Cancer Institute's budget by 10 times to $60 billion a year? Then we have a real shot at curing cancer, or
yeah,
or funding startups in the biotech industry with billions of dollars of funding, so that they can, you know, these companies that the government would be taking stakes in, they wouldn't be managed by government bureaucrats. They would be managed by America's best entrepreneurs and scientists. And so this is just a win-win situation that we need to take advantage of as quickly as possible. And if we do, our future is going to be very bright. But if we continue to lag behind China in making investments in new industries, then very quickly the United States is going to become a has-been, second-rate, vulnerable power, effectively at China's mercy. And we don't want that, of course.
yeah. Sounds like politicians are cluing into that, and they see that there's wealth benefits, health benefits, national security benefits. It trickles down into the economy and adds to the prosperity of the current generation and obviously future generations. So it sounds like there's a tremendous number of benefits. I don't know what the downside or cons are, if you will, other than maybe the potential cost of initially seeding or funding this thing, because where's the money going to come from? It's let's call it taxpayer dollars, but it has to come from somewhere. So, I mean, is that the downside of it? Is that, we're going to pay for it up front in the hopes of seeing returns down the road?
Well, I think it could be. I think it could be funded easily two different ways, or in some combination of these two ways. It could be funded directly by U.S. government borrowing and more government debt. Right now, U.S. government debt is about 120% of U.S. GDP, even after all the debt that the government incurred during COVID and after the crisis of 2008. Government debt to GDP is about 120%. Japan's government debt to GDP is 260% of GDP.
Wow.
Their government debt to GDP ratio blew past 120% about 30 years ago. So this suggests that it would be very easy for the U.S. just to take on more debt and make these initial investments. And of course, it would take 5 years, 5 to 10 years for these things to begin paying off massively. But then they would, and they would pay for themselves many times over. So that's one way, just through debt. But as I was alluding to earlier, the Fed could finance it through money creation. Before, um, not so long ago, the Fed was creating $120 billion a month. And after the crisis of 2008, the Fed increased its balance sheet by 5 times. In other words, the size of its total assets reflects how much money the Fed is creating. And they created $3.5 trillion between the end of 2008 and 2014. At that time, I think QE was, I think at that time it peaked around 90, I think it was 95 billion. Later, during COVID, it was up to 120 billion a month. Following the crisis of 2008, even though the Fed created so much money, that didn't lead to high rates of inflation. The highest rate of inflation we had at that time was in 2011. The CPI moved up to just 3.8%. That was the highest level of inflation we had, despite all of this money creation by the Fed following the crisis of 2008, and also despite the huge surge in government debt during that period. So at that time, they got away with having a lot of money creation without causing high rates of inflation. So I think this could also be funded through the Fed financing, money creation. Right now, the inflation rate has come back down to 2.5%. It peaked at 9.1% in the middle of 2022. And now it's essentially back quite close to the Fed's 2% inflation target, close enough that the Fed has now begun cutting interest rates. And if we have a recession, which generally we always do sooner or later, then the inflation rate will move lower and lower and potentially go negative again. And interest rates will come down very sharply. And in that sort of environment, it would be very easy for the government to borrow cheaply. And also, it would be very easy for the Fed to create money and buy these government bonds to finance these investments on a very large scale without the risk of creating high rates of inflation, because it would be back in a recessionary, deflationary environment. And we're essentially now back to where we were before COVID. Before COVID, globalization had been driving down inflation and interest rates in the United States starting in the early 1980s.
Because the cost of goods was becoming cheaper and cheaper because they were being manufactured all around the world, not just locally, correct?
That's right. Starting in the 1980s, the U.S. started running very large trade deficits for the first time. Up until then, U.S. trade had been in balance. And so that meant that if the government spent too much money or that the Fed created too much money, it would overstimulate the U.S. domestic economy. It would lead to full employment among the Americans, and it would lead to full industrial capacity utilization. The U.S. only has so many car factories and so many cement factories and steel factories, and only so many workers. But once globalization really got underway in the early 1980s, suddenly we no longer had this closed domestic economy. We could buy goods from the entire world. And the population of the entire world is about 23, 24 times larger than the US. And industrial capacity around the world is very much larger than US industrial capacity. So suddenly the size of our economy, rather than just having a closed domestic US economy, we had a global economy. And most of the workers in the global economy earn very much less than American workers do. So this was extremely disinflationary. Workers in China, Vietnam, Bangladesh, India, they earn 80%, 90% less than the Americans do. And so this drove down prices, and this drove down US wages, and this was extremely disinflationary. And this allowed the US government then to have larger budget deficits, and it allowed to stimulate the economy.
Right.
And it allowed the Fed to create a lot of money and to get away with this without creating high rates of inflation. But COVID dealt a severe blow to globalization because suddenly all the Americans were locked in at home. They couldn't go out and spend money on services. So they started ordering a lot of things through Amazon, like iPads and iPhones and jogging machines and other goods, most of which were made in China. But China was locked down. And so the supply chain was extremely disrupted. The Americans got stimulus checks from the government, so they had a lot of demand to buy things, but the supply dropped. Demand increased, supply dropped because of the
Right.
supply chain disruptions. And so we got high rates of inflation.
Right.
And then just when that started to abate, in February 2022, Russia invaded Ukraine. And we got another big wave of inflation in oil. When we spoke last time, oil prices were $110 to $120 a barrel. Now they're
Right.
at 70. And food prices spiked. Wheat, corn, and mineral prices spiked because of the war. So we got another round of inflation. But now these shocks to globalization have been worked out. You know, the idea of the Fed increasing the federal funds rate so much and so sharply to let's say 5.5%, was to cool down the U.S. economy. The idea was the Fed wanted to essentially throw American workers out of their jobs so that they wouldn't have enough demand to buy things anymore. They wanted to slow the economy down so that inflation would come down. But that didn't happen. The economy didn't slow down. The economy's been
Right.
very strong.
Right.
And what changed, the demand didn't slow. What changed is the supply improved radically as the supply chain bottlenecks got worked out. And with supply up and demand still good, the inflation rate came down. And we're now
Right.
back to roughly an inflation rate that we've had on average for most of this century. And it looks like it's heading lower.
Yeah. I
So
think.
this once again makes it possible for the government to fund the sort of investments
Yeah.
through a sovereign wealth fund that our country so badly needs without causing high rates of inflation.
I think in the last few minutes, you've probably touched on four, maybe five of, these six factors that you talked about that have an impact on our economy and the markets, the financial markets. And, it'd be interesting to just touch on these different factors real quick as we kind of get through the midpoint of this interview, because these are the things I definitely wanted to touch on in addition to the U.S. Sovereign wealth fund. But one of the things you just mentioned is the stimulus from 2020. You know, clearly there's some lingering effects or impact from the massive injections of capital or liquidity into the markets. And there's been, I mean, that fiscal and monetary stimulus has a huge impact, and it lingers for a while because that money's sloshing around in the system, whatever you want to call it. What is going on with the stimulus that we saw, that massive injection in 2020, I think into 2021? What's going on with that today, and where are we headed with that?
Yeah, so this is really interesting and really important. When last year, for instance, all the economists, including me, thought that the U.S. was going to go into a recession, but it didn't. Even though the Fed was hiking interest rates aggressively and carrying out quantitative tightening, the economy remained strong. It was growing above trend growth rates, and it still is. And why is that? Well, the reason must be that all the stimulus that the government sent out during COVID is still driving the economy forward. Government debt, but since the end of 2019, just before COVID started, government debt has doubled from roughly $18 trillion to roughly $35 trillion now. And during the first, which is an extraordinary surge in government debt, government stimulus that was pumped into the economy. And during the first 24 months of COVID, let's say from March 2020 to March 2024, during that 24-month period, the Fed created $5 trillion and bought government bonds, making it possible for the government to borrow so much money without driving up interest rates.
Mm.
And this stimulus on that scale is something that we've almost never seen before. This is kind
Mm-hmm.
of economic stimulus, fiscal and monetary stimulus on a warlike scale. Now, maybe not like World War II, but a medium-sized war. And when the government is in war, of course, they have big budget deficits and a lot of paper money creating, and that stimulates the economy. Even Russia's economy right now is booming because they're spending a lot of money fighting the war. So when you have a lot of government stimulus on a warlike scale, it drives the economy forward. You know, we had the Great Depression for 10 years during the 1930s. It didn't end until World War II started. And when World War II started, the government, of course, spent enormous amounts of money and borrowed enormous amounts of money. And the Fed created a lot of money in order to buy weapons and fight the war. And that stimulus was so large that when the war ended, it continued to drive the US economy forward all through the 50s and into the 1960s, and resulted in a lot of new technological advances in things like jet engines were created during that period, for instance, on the back of government investment in jet engines. So what we're seeing now, I think, is the lingering impact of this massive stimulus that we got during COVID is still driving the economy forward.
Yeah, it's fascinating. Um, can let me transition to something a little more local. One of the things I was reading from your recent slide deck and in your video, you were talking about how high the wealth to income ratio is in the United States, which is quite fascinating to me because on the surface, it sounds like it's a good thing, right? It's a great thing. We've got, wealthy Americans, they're asset rich, maybe not income rich, but asset rich. But it sounds like a good thing on the surface. But I think the reason you pointed out, maybe what you're implying is that's not a good thing because there's the possibility that if asset prices deflate, our net worth is going to go down. We won't be as wealthy, however you want to measure that. And there could be a psychological impact to that. There could be a borrowing and spending impact to that. But the net worth as a percentage of disposable income is at almost like near a historic high or an all-time high. What happens if that changes? Like, what happens if asset prices come down for whatever reason? I mean, with mortgage or with interest rates going down, you'd think that there'd be more liquidity and it'll push asset prices back up again, and we'll have like new highs. But what happens if that flips around and we start to lose that wealth?
Right. Well, linking this into what we were just discussing about this the impact of the stimulus, one of the
Yeah,
impacts of the stimulus was that it created an extraordinary boom in wealth in the United States. Now, wealth
right.
is called household sector net worth, which is calculated. You take all of the assets of the Americans and subtract their liabilities.
Yeah,
That's the net worth. That is wealth of the American public. And this increased. I was just looking at these numbers a few minutes ago. It increased from the end of 2019, just before COVID started, up until the middle of this year. Household wealth increased by $47 trillion, which is about 40% increase in wealth in 4.5 years or 5 years.
that's a lot.
$47 trillion. I mean, to put $47 trillion increase in wealth into perspective, the entire U.S. government debt is only $35 trillion. So this is enough money to pay off all the government debt with $12 trillion left over. So this stimulus has created this extraordinary boom in wealth. And the wealth, of course, is one of the things that's helping to stimulate the economy because it allows people to consume more. And the
Yeah,
consumption makes up nearly 70% of the economy. But stock prices are high, property prices are high. That's why the wealth went up. And now this has resulted in an unusual surge in the ratio that I call the wealth to income ratio. So this wealth to income ratio is something that I've looked at for a long time. It's actually published by the Fed. And what it is this household sector net worth that I just described, wealth, which is now $164 trillion. of wealth,
Right.
164 trillion, relative to disposable personal income, wealth to income. So this wealth to income ratio, going back to 1950, the average has been 550%, the ratio, 550% wealth to income. During the NASDAQ bubble, it shot up to a new high of 620%. And
Hmm.
then the NASDAQ bubble popped and it went back to its long-term average of 550. A few years later, the property bubble, it went up to 680%. And then the property bubble blew up and the US went into recession and it went back to its long-term average of 550%. Well, now this wealth to income ratio is completely off the charts. It's up to, the previous high was 680, now it's 750. And that suggests that asset prices are very inflated relative to income. And this suggests that asset prices are very vulnerable to any sort of shock, whatever that might be. If history is any guide, there's a real risk that this is going to plunge back to its long-term average of 550%. And if it does, of course, that would be destroy 30, $40 trillion of wealth and clearly throw the US into a severe recession. So that's something I worry about, is this inflated wealth to income ratio. It's been elevated for a number of years. Initially, people used to say, okay, well, interest rates were so low before the Fed started hiking a couple of years ago. Interest rates were so low that justified high asset prices. But even after the Fed increased the federal funds rate to nearly 5.5%, the asset prices remained high. And so they didn't correct. And now the Fed's beginning to cut interest rates, which, if anything, should help asset prices go higher in and of itself, all other things remaining unchanged, which, of course,
Right.
they never do. Yeah, this is something that I watch and worry about. So one of the things I worry about is that um, asset prices are clearly inflated relative to historic norms, relative to income, and suggesting they're vulnerable to any sort of shock.
So what makes up the majority of that wealth? Is it a principal residence? Is it real estate in general? Is it equities like the stock market? I mean, what's in that basket of wealth?
So the main items are real estate and directly owned equity, stocks, individuals owning stocks, but also uh, pension money, pension entitlements make up a large part of that. And then also bank accounts, savings. Those are the main things. Properties, stocks, pension entitlements, and deposits in the bank. Those are the main items. And of course, the stock market has soared and property prices have gone up sharply as well. And therefore, the pension entitlements have also, the pension funds now have much more wealth in them than they did before.
Interesting. Okay. And so your greatest concern about that is a shift in interest rates, changing that, or income's not going up fast enough.
My, well, it's vulnerable from many different angles. If inflation were to start picking up again and the Feds started hiking interest rates again, that would be a that would really probably pop this bubble in asset prices. Um, and that's why I'm concerned about the risk of protectionism. In my work, I really try to stay out of politics. Uh, I want to be friends with both sides in terms of I'd like both sides to listen to my economic recommendations. I don't want to
Right.
alienate either side. I don't want to alienate half the country. So I try to stay out of politics. But
Right.
if we did have very high trade tariffs imposed next year, say 100% trade tariffs on China or 200% trade tariffs on the things that Deere manufactures in Mexico and brings back into the United States, or 10 to 20% trade tariffs imposed on all of our trading partners around the world, that would clearly be extremely inflationary. That would sort of take us back to where we were before globalization drove down. We would once again have a closed domestic economy with a limited number of people in the workforce, and a limited number of factories, and suddenly everyone would be fully employed and wages would go up and would get in this wage push inflation spiral as we were
Right.
in the early 1970s. And the Fed would have to increase, pretty soon would have double-digit inflation. We would have double-digit federal funds rates and double-digit mortgage rates. And that would be certain to crash the economy and crush asset prices. So that's something that is very concerning. And that I would say that is the, many things can happen. A lot of things happen that you don't see coming, but it is very certain in my mind, at least, that if we did have protectionism on that scale, very high levels of trade tariffs, then it would be a disaster for the economy and for wealth, property owners, stock owners, and
Right.
essentially all Americans.
Right. Yeah.
So hopefully that doesn't happen.
Yeah. You've mentioned interest rates many, many times. What does your crystal ball say about the Fed funds rate? And if you want to touch upon it, mortgage rates. Where do you see interest rates going over the next, let's say, quarter, year, few years?
So I've just produced a new Macro Watch video yesterday, or uploaded it yesterday, discussing how the Fed controls interest rates. Now, people know the Fed cut interest rates last week by 50 basis points, but I don't think most people don't understand how the Fed controls interest rates. What did the Fed do to make interest rates go down by 50 basis points?
Right.
But it's very interesting in that after all of the paper money that the Fed created, or the money the Fed created during COVID, that created a lot of excess liquidity throughout the economy. The Fed creates money and pumps it into the banking system. And suddenly the banking system is flooded with money. And on a roughly $4 trillion of excess liquidity in the banking system now, bank reserves. Now, when the Fed wanted to increase interest rates this time, they actually had to pay the banks interest on those bank reserves to make
Right.
interest rates go up. That's not the way they controlled it in the past. I won't go into the way they controlled interest rates in the past. It's a bit detailed. But what people need to understand now is the reason that the federal funds rate went up to 5.5% is because the Fed paid interest on bank reserves of just almost 5.5%. It was roughly 5.3%. So the Fed pays interest on bank reserves, and that ensures that the banks will not lend to anyone at less than 5.3% interest. Why would they lend to anyone at less than 5.3% interest if the Fed is going to pay them 5.3% interest, right?
Right.
So the Fed controls interest rates by paying interest on all of this excess liquidity that it created during all these rounds of quantitative easing. What changed last week? Instead of paying 5.3% interest on bank reserves, now the Fed's paying 50 basis points less. It's paying 4.8% on bank reserves. And if the Fed were not paying interest on bank reserves, interest rates would collapse, because there's no place else this $4 trillion of excess liquidity that's swashing around in the banking system. That $4 trillion can't earn 4.8% interest anywhere else. No one else is going to pay them 4.8% interest. So if the Fed suddenly stopped paying interest on bank reserves, interest rates would plunge back to 2% or 1% as it was earlier, because there's just so much excess liquidity. There are no
Right.
viable investment opportunities that will pay the banks so much. So the main point here for people to understand is interest rates are at the current level because the Fed is paying interest, a very high rate of interest, to hold them up. And the Fed, when it reduces rates as it did last week, it does it by reducing the amount of interest it pays on the excess liquidity. So the Fed can control these interest rates by paying less interest on bank reserves. And right now, even after this rate cut last week, the federal funds rate is, let's call it 4.8%. It's a range between 4.75 and 5%. That's twice as high as the inflation rate. So that's very tight monetary policy. The
Yeah.
inflation rate's 2.5%. The Fed's paying 4.8% to keep the federal funds rate high. So the Fed's going, it looks like the inflation rate is going to keep moving lower. We already have goods are actually deflating. You can break the inflation numbers up into three big components: core goods inflation, core services, and housing services. Well, the goods inflation, things like automobiles and washing machines, those are actually deflating again.
Mm-hmm.
Those prices are negative. They're falling year on year and have been for more than a year already. And the other two components are also coming down, although they're still a bit higher than the Fed would like. So the inflation looks like it's going to keep dropping. And there's a real concern that it's going to soon fall below the Fed's 2% inflation target. The
Wow.
Fed wants to have 2% inflation. During most of this century, the Fed had to struggle to make inflation be up to 2%. It couldn't get the inflation rate up to its 2% target. It doesn't want to have deflation.
Right.
So if they're not careful with the rates so restrictive, and at the same time that the Fed is destroying money through quantitative tightening, as it's also doing now, destroying money, roughly $60 billion a month, that's very restrictive monetary policy. So they are very likely to keep cutting the federal funds rate. Uh, in fact, the members of the FOMC, the people who work at the Fed and make decisions on interest rates, they publish their projections about what they expect interest rates to be over the next couple of years. And they have told us that they expect that the federal funds rate will drop from where it is now, around 4.8%, to 4.4% by the end of this year, 3.4% by the end of next year, and 2.9% by the end of 2026.
Wow.
So it looks very likely that interest rates are going to keep moving lower.
Mm-hmm.
Of course, this is based on the current information that they have now and the current data that they have now. Things could change next year. As I was just saying earlier, if the new administration imposes very high trade tariffs, then we're going to get a new spike in inflation, and all this would change. But as things stand now, it looks like the inflation rate is going to keep coming down, and it looks like interest rates are going to come down quite sharply. And that should be good for property prices
Right.
and for equity
Yeah.
prices. But there is one thing I wonder, Marco, and you may probably have a better feel for this than I do. I've I've always read so frequently that one reason that property prices in the U.S. have moved up over the last few years is because there are so few sellers. Because people are locked into very low rate mortgages, right? They have
Yeah.
mortgages from 3 or 4 years ago, 2% mortgage rates or extremely low mortgage rates. If they sell their house now, they'll have to refinance at 6 or 7% interest on a new mortgage. So there's
Yeah.
no supply of homes because of this mortgage situation. If interest rates do move down and mortgage rates do move much lower, which seems quite possible, do you think that suddenly there'll be a wave of sellers of homes around the country who have been reluctant to sell up until now because their mortgage rates were so low before and they wanted to lock them in? What if there's
Yeah.
a new wave of selling for this reason? With new supply of homes, perhaps that would put some downward pressure on home prices rather than what you would intuitively expect that lower interest rates would lead to higher home prices. What do you think about that?
I don't think it's going to push prices down, but it'll slow or curb the appreciation rate of appreciation in many markets. There's an undersupply of housing. We have a 1.2 million housing unit shortage right now in the country in terms of the supply versus demand. If mortgage rates go down, like you're talking about, it will bring some people out of the woodwork to move, whether move up, move laterally, but let their home go and get that low rate mortgage off their books. They'll get a new mortgage at a comparable mortgage rate, but at least they'll take up one more housing unit, free up one more housing unit in the resale market. It's not going to, I don't know if it's going to make a big impact, but it certainly will free up housing in the resale market. But builders are building like crazy right now to put out inventory to keep up with the natural demand, the organic demand that we have for housing. We have almost a historic number of shortfall housing units out there, 1.2 million. And that's not going to correct itself anytime soon. It's already predicted that it's going to be at least 2030 or beyond before we reach a level of equilibrium. So could it help? Potentially, but it can also fuel the fire, because if mortgage rates go down, affordability goes up, more people can get
Right.
into the housing market. They could buy their first or their next home, and that increases demand, which will push prices back up, which adds to inflation because housing is a cost of living. So it's an interesting dynamic, between all that.
It,
Part of it is driven heavily by interest rates because that affects affordability, but also supply and demand plays heavily into housing.
right. It will be interesting to see how that plays out. I mean, like you said, intuitively, you would expect lower mortgage rates to make property prices go higher. I'm just wondering about this other possible wild card that may make things turn out otherwise. Everyone
Well,
thought that the higher interest rates would push property prices down, right? As the Fed was hiking, there was a real fear that property prices would fall. But instead of falling, they went up. Um,
I think it'll just make the problem worse, and the reason for that is there are a lot of households that have um, um, multiple people living in there only because they can't afford to live on their own. So if mortgage rates go down, affordability goes up. Those people who would effectively take up two housing units or potentially three that are living in one under one roof, now all of a sudden doubles the number of housing units needed from that one household. And so now you've rapidly increased the amount of demand for housing, and that's going to create a massive problem. I mean, if you're a property owner, it's a great thing. Your
right,
equity just doubled.
right, right.
So, but yeah, there's a lot of people, even in their 20s and 30s, that are still living at home or bunking up with other people because, they can't afford a house on their own.
Well, the good news then, because according to the Fed officials themselves, they're expecting to cut interest rates by another 200 basis points over the next couple of years.
Wow. Well, well, the mortgage rates are affected by the bond market more so than, the Fed funds rate. But if, I don't know if those work one to one linearly, but if they do, then yeah, we're going to see mortgage rates drop, and that'll be another housing boom.
I think we will keep seeing mortgage rates drop in that scenario because, as I was just saying before, right now the Fed's paying 4.8% interest on about to the banks on bank reserves on about $4 trillion of bank reserves. If they pay 200 basis points less, then there's going to be $4 trillion looking around for new investment opportunities at a much lower level of interest. So all of the market determined interest rates should also move lower as well, including mortgage rates. Because the mortgage rates are really still quite elevated relative to, currently they're much higher now than they have been most of the time since 2010.
Well, the long-term mortgage rate, if you go back about 30, 35 years, is 7%, if you just want to look at it historically. Um, so we're right around there right now. But yeah, I mean, if we drop below 7, it'll spur activity. If we drop below 6, you definitely see more activity. And if we get below 5 again, I think watch out. We're going to see another housing boom. So,
Well, as long
uh,
as globalization persists and we continue to have downward pressure on imported good prices and disinflation, then there's every reason to expect, I believe, that inflation will be very low as it has been during most of this century. And in
mm,
that case, interest rates should also be much lower than they are now.
I've heard it said that we live in interesting times, and I can't help but think we live in interesting times.
We definitely
So,
do.
yeah, we'll see how it goes. Well, Richard, I've taken up a lot of your time. I appreciate you staying on. This has been great. I love the content. I love your newsletter. Macro Watch is fantastic. So tell our listeners how they can follow you, find you, subscribe to Macro Watch, your books, anything else you want to share.
Thanks, Marco. Yes, so my business is Macro Watch. Macro Watch is a video newsletter. Every couple of weeks, I come out with a new video. It's typically about 20 minutes long, and it has 30 or 40 charts that you can download. It's discussing something happening in the global economy and how that's likely to impact asset prices, things that we've been discussing toward the latter end of our conversation today. And it's been going on now for 11 years. I launched Macro Watch 11 years ago. So if your viewers, listeners are interested in learning more about Macro Watch and following my work, I would encourage them to visit my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. And if they'd like to subscribe to Macro Watch, hit the subscribe button. I'd like to offer them a 50% subscription discount. If they hit the subscribe button, they'll be prompted to put in a discount coupon code. If they put in the coupon code passive, then they can subscribe at a 50% discount to Macro Watch. And they will find that it is very affordable. It's not expensive at all. And they will get a new video from me every couple of weeks for the next year. And they will also have access to all of the videos in the archives, now more than 100 hours of videos in the Macro Watch archives. So I hope your listeners and viewers will check that out at richardduncaneconomics.com.
Yeah, and I speak highly about it. I mean, I've been a subscriber for years. It's worth every penny. It's inexpensive, affordable. It is chock full of information. You've got a great slide deck with every video. You explain things very well. I can't speak highly enough about it. I think it's great. Anybody who wants kind of like a big picture, what's going on the world stage, information and trends, it's all there. So, I mean, you don't really need to go anywhere else.
Well, thanks, Marco. The big theme of it is that the economy just doesn't work the way it used to when money was backed by gold. Now it works very differently. And so I explain how the economy really works in the 20th century, because it doesn't work the way that it did when money was backed by gold. There were a lot of constraints then that no longer exist now. And if you don't understand how the economy works now, then you're going to be not at all well positioned to make wise investment decisions.
Right. Yep. So if you care about your economic and financial future, this is a great source of education for you. So I think it's well worth it, 100%.
Thank you for the good recommendation.
Yeah, definitely. Well, Richard, thanks for coming back on. Maybe we'll have you back on in not 2 years from now, but probably into the new year. How about we do that?
Let's do that. I would like that.
Perfect. Okay. Well, again, thanks for coming on. Thanks for your time. And we will see you again soon, Richard. So thank you.
Great. Thanks for having me on.
Thank you. That when you have predictable and sustainable passive income,